All right. Now, the latest information that has been provided by the Association of Mutual Funds in India, or AMFI, relating to the inflows in the month of November, have pointed to healthy inflows once again into multi-asset funds. And this is in the hybrid category. The hybrid category overall getting inflows of about 13,300 crore rupees, but as much as 5,300 crore rupees flowing into multi-asset funds. The question is, how are these hybrid schemes allocating their funds? Are they gravitating more towards commodities for multi-asset funds, especially with gold and silver rising from high to high? Or are they going towards equity, considering that there are certain pockets where the belief is that 2026 is going to look much better for equities than 2025 has been? Let's talk about the strategy as things stand right now in the month of December, and how things look going forward. We've got Sharad Tandon, founder of Invest at Ease, joining in to talk about some of those aspects. Hi, Sharad. Thanks so much for taking the time. If I look at multi-asset funds, which schemes in that category continue to have high allocation towards commodities, because they've run up quite considerably?
So, Alex, as you rightly pointed out, most of the MAF performance for last year was based on the commodity rally. And if you read through the commentaries which the fund managers have provided in the fact sheets of the portfolio disclosures, there are three categories of or classification of the commentaries you can put into. One is people like UTI and, say, to an extent Bajaj, who have tapered down their commodity exposure to an extent, and they are trying to go to their target allocation state in the which was mentioned in the average offer document. While someone like, say, Prudential would do something similar, but in a different way. They have taken some exposure at some months in oil and some months in copper, or combination of both, and they play it around that. But or say even something like Bandhan, if I recall right, they are looking to their target allocation is sticking to that, where their commodity stands as a percentage of 8-10%. On the gold side, they will stay there. Equity stays at 50% odd. But these are three separate types of dynamics the fund manager are playing, depending on what they perceive of their portfolio and how they are aligned to the going forward in 2026. Net net in the industry level, has the commodity allocation being pared down? Answer is no. It might be minor here and there, a percentage points up or down, depending on fund to fund. But people are still bullish on gold and silver to play around there, though not at the probably at the same rate as what they did in 2025, or say currently doing in Jan to December now. They probably will taper down, but they are maintaining their allocation there more as a hedge on the global conditions.
Interesting. Okay. So, which is important, considering that there are some schemes, White Oak Capital for one, that had gone closer to that 20% mark, but then they've rolled it back considerably as you hit those life highs for gold and indeed silver. But if I were to ask you to bucket multi-asset funds into three broad objectives, because schemes and fund managers interpret things differently, right? The way that the mandate is given. One would be profit maximization, where you have more equity allocation, and incidentally, you also get that equity taxation. You also have, on the other end of the spectrum, capital protection, where they expect that you will get close to your nominal GDP kind of growth rate over a longer period of time. And then you have a combination of the two, which shuttle between the various allocations tactically, and that can move quite sharply. So how do you bucket these three, and can you give me examples of these three objectives?
So, Alex, let's go back to the background how and why the maps were created. And see, maps are nothing else but an offshoot of a balanced fund. And we said, ki boss, on balanced fund, we are getting as good as a FD return. So we went into hybrid aggressive, which were slightly more aggressive on the equity allocation. Then we said, well, commodity is a hedge to the currency and the dollar movement. So we'll look an exposure there, or a hedge to the equity. So we added gold, then we went on further to silver, REITs, InvITs, whatever way you want to call it. People went to the extent of forex exposure on currency swaps also. Now, based on this, there are three categories of fund in the industry which you can classify, put together in three buckets, as you call it. One is sort of three, four funds which will look at maximizing profit. Their objective is very simple, boss. I'll maximize profit. I'll go into pockets where I find value and I'll grow it big. The second is of products which will be like akin to a balance advantage fund, which are saying I'll protect capital, I'll take lesser risk, but give you slightly more than that. Now, the third one is more like a true fund manager, I call them, because they are taking a call on tactical allocation. So I put them in a bucket which you can call a balance or a strategic investments, and they can play around in any category, capital protection or the growth option or profit maximization, as you might call it. Now, in industry, what happens is capital protection. One of the better examples are something like, say, SDFC, BAF, or even Bajaj MAF. So now Bajaj has gone a step further. Bajaj says on the equity side, I'll only look at high dividend yield stocks. Now, all of us know, given our background, the dividend yield stocks are typically assumed to be slightly safer and less volatile than the other stocks. So they maintain, if Nifty current, say, dividend yield is around 1.25, their equity exposure is having a dividend yield of around 1.5, 1.6, and they play with commodity there. Now, that's something a unique model they have. SBI typically, historically, has been very steady, stable portfolio, but their objective is very clear and maximize profit. So they typically shuffle between categories of the allocations very high. Something like Prudential BAF typically goes by the a guideline scale they have created, or Access multi-asset, or even say DSP multi-asset, where they shuffle between commodity, gold. DSP also goes to the international equity. And similarly, Prudential takes extreme steps. Another, they play in oil futures and copper also to an extent, also the InvITs. Now, you pick and choose. These are tactical allocation, and you'll find in various months some allocations being zero, some allocation with 3 to 4%. Uh, for example, in say, if I recall right, Axis Gold exposure at one point of time was higher of 12, now it's 7, 8. Bajaj has consistently managed 7, 8. It's a combination of these three buckets where people can play around with what they want to do.
So therefore, I think it's important that you've pointed that out, because you need to set your own expectations and what you are using this scheme for. And a lot of people say that if you have relatively lower risk appetite, you should gravitate towards a multi-asset fund, and it is a long-term strategy. It's not something that you should look at for 1 year or 1.5 years. You should look at 3 year plus, and you can look at this even people who are in their retirement time frame, because it gives them that capital appreciation that equity does normally, and the trade-off between gold and fixed income to balance when equity is not doing well, and to protect the downside respectively, right? So how do you comment about the performance over the last 1 year, which has been phenomenal for these asset allocation schemes, multi-asset schemes, compared with BAF or balanced advantage funds, and how do you decide between the two?
So Alex rightly pointed out, last 1 year, or say 2025. So I'm saying last 1 year because we are practically in December. So calendar year this 25, practically four things have played out very well. Gold price, silver price, to an extent foreign equity, especially if you have got exposure to stocks like Nvidia or Tencent or things like that. Typically, not the fangs of the US, but the technology chip savvy metals or commodities in that space. Now, other thing which is played out well is commercial real estate to an extent in certain pockets, depending on which pockets you have played around with.
What I'm asking is, how do you select between the two?
Yeah. So based on this, each of the portfolio people will have to look at which fund has taken how much exposure into what pockets outside equity and debt. Because that is what is creating either alpha positive or negative. Now, thumb rule is, if like you quoted example of retirement people, the MAFs typically in a 3 year period will outperform inflation by 2-3 percentage points. Taking that additional risk into commodity, can it give 1%, 2% kicker? Answer is yes. But should they look at it? Is a choice, depending on individual client how much risk they want to take.
Yeah.
But otherwise, thumb rule is retired person go for a capital preservation model or a tactical allocation models like say Bajaj, SDFC, Prudentials of the world.
Fantastic. And between multi-asset and balanced advantage, you would prefer the former?
So it has to be split, Alex. Let's not go by this 11 months performance, because MAF would have outperformed BAF by 7-8 percentage point on a lump sum investment. On the SIP, they would have outperformed by 2-3 percentage point on an average in the category, MAF versus BAF. But if you look at a 3-year horizon, 5-year horizon, the returns will fall in line with closer to both being tapering towards one side, which is around 12 to 13% annualized return, which the BAFs have also given.
Okay.
So my advice is split the allocation depending on the risk profile you want to take.
Yeah, and if you want to have that allocation towards commodities without actively seeking it elsewhere, you can actually look at this investment. Thanks so much, Sharad, for taking the time. Pleasure speaking with you.
My pleasure, Alex. Thanks a ton.
All right, that brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in. This is NDTV Profit.